今天我们特别有邀请人在伦敦的贝莱德智库全球首席策略师威利。Can you hear us, Willie? Good morning.
Good morning, good afternoon. Thank you so much for having me. And thank you so much for your wonderful introduction as well. It's a pleasure to be with all of you, even though I wish to be there in person. It's really a privilege to be part of this wonderful event. So building on the remarks just now, and by the way, I thought they were excellent. I will spend 10 minutes talking about my thinking process around the AI revolution, around the US political landscape, as well as investment opportunities as a result of that. Starting with the first slide, starting with the big context, we believe that we're currently in the fourth industrial revolution. So what we did on this particular slide is to add up the capex spent of previous industrial revolutions. The first one, the second one, the third one, the steam engine, the internet revolution, and we compare that with the capex estimate of the current technological revolution. We added up the AI revolution as well as the capex spend for the low carbon transition, and the capex spend is represented by the red bar on this chart, and you see that they are comparable. What we're going through right now is comparable to previous industrial revolutions, except that they are happening at a much faster pace. And of course, this is then going to really imply significant impact on the global economy, as well as what it means for productivity, what it means for investing as well. The yellow bar on this slide represent productivity boost in previous industrial revolutions, and because it is too early to estimate what the current AI revolution would bring in terms of productivity, we represented it by a question mark on this slide. But moving to the next slide, you see a wide range of outcome, a wide range of estimates in terms of how much productivity gain the current AI revolution can bring. We're talking about a range going from 0.1% to 1.5%, as you can see on the left-hand side of this slide. And where we end up on this wide range of spectrum depends on the degree to which AI is adopted across the economy. It depends on energy constraint, because it requires a lot of energy to power the AI build out, infrastructure build out, and it also depends on the regulatory landscape as well. But the important point here is that wherever we fall within this wide range of outcomes, there will be investment opportunities coming out of the AI revolution. We are already seeing new revenues being created from innovative AI applications. And if we're talking about an environment where the competition for AI model intensifies, then the builders of AI model, the builders of the providers of AI models can charge rent, and they seek rent, and they drive and grow and extract additional profitability from that. But if we're talking about an environment where AI becomes common utility, becomes more table stakes, then application and users of AI then will be in a position to extract even more profitability and benefit from AI. So we see three phases as we think about the AI revolution. The first phase is the build-out phase, which is where we have been for the last 18 months or so. And the second phase is the AI adoption phase, where we see more sectors applying AI in their day-to-day and drive profitability, which is starting to happen in parts of the US equity market. And the third phase is the transformation phase, where we see more concrete productivity boost. And that is still in the future. We're seeing pockets of productivity growth in sectors such as technology, for example, and telecommunications, but economy-wide productivity gain that will take time. And again, it depends on a lot of factors, regulatory, energy constraint, and also the pace of adoption. It then determines where we are on this wide range of outcome. But the big picture is that we are in this very unique environment where cyclical forces are interacting with structural forces like AI, like low carbon transition, like rewiring of global supply chains. And as a result of that, the typical cyclical playbook does not quite apply as we interpret what's happening in markets, as we interpret what's happening to the economy. And the evidence of that is on the next is on the right hand side of this slide, where you see the sensitivity of US market. In this case, we're talking about 10-year government bond yield to the sensitivity of 10-year government bond yield to economic surprises. We're currently at a much more sensitive level compared to pre-pandemic levels. And that really goes to show that we are indeed in a environment characterized by transformations, characterized by structural forces, and the cyclical playbook doesn't quite apply. So what does this environment mean? What does that mean for investing, for portfolio construction? If we can go to the next slide, please. So here it shows that we are in an environment of higher rates, higher inflation for longer, and I think this agrees. This is very much in agreement with the previous speaker as well. And this is really reflective of this environment shaped by supply constraint because of the structural transformations that are happening, that are competing for similar resources. We're talking about the low carbon transition, the build out of data centers, the build out of AI infrastructure, all demanding greater energy, for example, and that actually represents greater demand, inflationary pressure, and higher rates for longer as a result. And this is reflected in the chart on this particular slide that shows market estimate of neutral rate has been increasing in recent years. Neutral rate is the rate at which above the neutral rate, we're talking about more restrictive monetary environment, and below neutral rate, we're talking about more stimulative monetary environment. And the estimate of neutral rate has been low in the period after global financial crises, and in recent years, in this environment of supply constraint, that has been going higher. And that is also particularly the case when we're talking about greater fiscal spend in a new government, incoming government in the US. We're talking about the previous speaker already. No matter who won the election, we're talking about greater fiscal spend, and that means higher rates for longer. So how do we position portfolios for this environment of higher for longer? In fixed income, we're talking about an environment where income is here for longer. we have exited the environment of low rate, zero rate environment where income is very hard to come by. And now we can get income in quality bonds, and we do like that. So quality income for longer in fixed income. In equities, we would like to have exposure to growth drivers such as AI, and there's no better place for that than the US equity market, which is why we have been overweight US equity market since last year. And also I want to throw in private market as well. That is a good asset class to consider to position for high for longer. So here we're talking about real assets, we're talking about infrastructure as well. As examples of private markets that are important to consider for portfolio construction in this environment of higher for longer. Now, I talked about the US equity market. One question that I get a lot from investors and clients is that the US equity market have been outperforming the rest of the world for a long time. Are they too expensive at this point? And just for how long can US exceptionalism continue? So if we can go to the next slide, which is my last slide, I want to finish on this slide. The chart, we have two charts here. The chart really compares US with the rest of the world. The US is represented by the red line, and the rest of the world, so all country world, ex-US, represented by the yellow line. And the left-hand side of the slide is the price appreciation, price comparison. The right-hand side is the earnings comparison. So what is really, really clear from this analysis is that US exceptionalism is very real. You see US equity market outperforming the rest of the world since global financial crises, but this chart also shows that US exceptionalism is expensive because price has appreciated more than US earnings has outperformed the rest of the world. So when we bring all of that together, I think it's reasonable to expect that for as long as we believe transformations were to continue to drive the environment, and there are good drivers of AI revolution continuing and the runway is long, the markets will continue to want to pay for future growth. So just to summarize and bring everything together, we are in an environment of transformations, and we're talking about transformations across multiple dimensions. We're talking about AI revolution, we're talking about the low carbon transition, we're talking about transforming the global supply chain in this environment of a new geopolitical paradigm. So when we bring all of that together, structural forces, mega forces, matter actually more than cyclical ebbs and flows. And the traditional old playbook, the traditional lens with a cyclical tilt will no longer apply in this environment of transformations. And transformations create exciting opportunities. In particular, we are excited about US equity market, both in the specific around AI theme, but also more broadly as well, where valuation is less stretched. And with that, thank you so much for your attention. Back to your host, please.
Thank you, Wei Li.